So Jerome Powell just did something absolutely crazy. He cut interest rates by 50 basis points. This has massive market implications. I'm going to explain to you everything that you need to know, and I have a massive trade that I just did. It's not too late to get into this trade. I'm going to show you that trade in a little bit, but you have to understand this information because this trade could be a once-in-a-lifetime opportunity, and this doesn't come around all the time. So I'm going to play a video of the press release that he just did. I'm going to play it in 1.25 speed just to save you a little bit of time. So here's the interview right now, and then I'm going to break everything down after that and show you the trade.
Our economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state. Inflation has eased substantially from a peak of 7% to an estimated 2.2% as of August. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a half percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%. Recent indicators suggest that economic activity has continued to expand at a solid pace. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment fell back in the second quarter after rising strongly in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In the labor market, conditions have continued to cool. The unemployment rate has moved up, but remains low at 4.2%. Overall, a broad set of indicators suggest that conditions in the labor market are now less tight than just before the pandemic in 2019.
So super quick mid-video update, Jerome Powell just said the economy is strong, inflation's coming down, there's still demand from the consumer side in the economy, the labor market is cooling back to normal levels, and this has a lot of implications for the stock market. The trade that I'm going to show you in just a minute after this interview is done, it makes a lot of sense.
Inflation has eased notably over the past 2 years, but remains above our longer run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.2% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 2.7%. Longer-term inflation expectations appear to remain well anchored. The median projection in the SEP for total PCE inflation is 2.3% this year and 2.1% next year, somewhat lower than projected in June. Thereafter, the median projection is 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. For much of the past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight. Our primary focus had been on bringing down inflation, and appropriately so. Our restrictive monetary policy has helped restore the balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remain well anchored. Our patient approach over the past year has paid dividends. Inflation is now much closer to our objective, and we have gained greater confidence that inflation is moving sustainably toward 2%. As inflation has declined and the labor market has cooled, the upside risks to inflation have diminished and the downside risks to employment have increased. We now see the risks to achieving our employment and inflation goals as roughly in balance, and we are attentive to the risks to both sides of our dual mandate. In light of the progress on inflation and the balance of risks, at today's meeting, the committee decided to lower the target range for the federal funds rate by a half percentage point to 4.75% to 5%. This recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we begin the process of moving toward a more neutral stance. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing restraint too slowly could unduly weaken economic activity and employment. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025. If the economy remains solid and inflation persists, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate.
So I don't know about you, but I think that Jerome Powell sounds pretty dovish right now. He literally just said that right now we're at 5.5% on our interest rates. By the end of next year, by the end of 2025, interest rates are going to be at 3.4%. That is over 2 percentage points of cuts in about 1 year. That is massive. And this has massive implications for the stock market. In just a second, I'm going to show you one of the stocks that could absolutely moon based on this information. I don't think it's too late to get into this trade, but you probably want to do it soon if you want to realize the full profit. So this is the CME Fed watch tool. Just a little bit ago, the target range was 5.5%, but they literally just cut rates right now by 50 basis points. So that's why it's 5% right now. So up here on the top, we have October 29th of 2025. So roughly 1 year from right now, the middle range of rates is roughly expected to be around 3%. So the range right now is 5%. It's expected to go to 3%. So we have an additional 2 percentage points of cuts expected to come to the market in the next 1 year. So now we're going to hop into my trading account and I'm going to show you the exact trade that I made. My account value right now is $789,000. My 2-year return, I made $505,000. 1 year, $319,000. Year to date, I'm up $283,000. I have a free stock market blueprint that really helps out the average Joe investor. There's a link for that below in the description. It's totally free. Just click that and you'll be in. So this is some of the stuff that I have open in my trading account. The total value is $725,000. This is a little bit smaller than the amount that I just showed you before because I have different trading accounts. I have a couple different accounts. So total gain loss on this portfolio right now, $236,000 of unrealized capital gains. So these are my shares that I own straight up. These are some options that I have straight up. But right here, TLT, this is the one that I want to talk about. So I bought 20 call contracts with the 101 strike price, and they expire March 21st of 2025. I'm currently down about $500 on this trade right now, but I'm probably going to add more to this because I really think that the market has a big inefficiency how it's pricing TLT right now. So TLT is the iShares 20 plus year treasury bond ETF. So here's what happens. When the Fed cuts interest rates, when inflation falls, they want to cut interest rates even more. So as interest rates fall, that means bond yields will fall. And when bond yields fall, bond prices will go up. So if bond prices go up, this will go up too. TLT tracks the prices of bonds. Bond prices and bond yields move inverse of each other, so you really got to make sure you understand that. If bond prices go up, bond yields go down. I think the bond yields are going to go down going into the future. Now remember, I told you that the market is roughly forward-looking by 6 to 12 months. So now you're probably wondering how much juice is left in this trade. Is it too late to get into this trade? The answer, in my opinion, is no. I could be wrong, but let me explain to you my thought process behind this. So this chart right here shows you the history of what the federal funds effective rate was at over the last cutting cycle and the one that we're in right now. So from 2016 to 2020, that's one cycle, and then from 2022 till currently is the cycle that we're in right now. So in January of 2019, the Fed signaled that they were going to cut rates in that cycle. They went from 2.4% all the way down to roughly zero, so they did an interest rate cut of 2.4%, which is very similar to what we're expecting in the next 1 year. So now we're going to head over to the chart of TLT to see what it did from January of 2019 until roughly May of 2020. So January of 2019, TLT's price was roughly $120 a share. But if we go to May of the following year, it went to $167. So it made a pretty big move right there. So that's based on an interest rate cut of 2.4%, which is very similar to what we're expecting in the next year from right now. So that's why I think there's a lot of juice left in this trade. So that move from here to here was roughly 35%. Now that might not sound like a lot, but when you have call options and your stock goes up 35%, you can make a crap ton of money. Now, if you want to get a little bit risky, you could check out TMF, where TMF is roughly the same thing as TLT, except that TMF is triple leverage. So TMF will go up or down triple versus what TLT will do. So if TLT did 35%, TMF will do roughly over 100%. So 100% move when you have call options, you can make a crap ton of money. Now I think that TMF is a little bit more risky than what I want to do just because it's triple leverage up and down, and it gets complicated when you have triple leverage ETFs because you're compounding off of a lower number when it falls. So it's triple leverage, but it's triple leverage down too. And when you fall in a triple leverage format, when it has to go back up, it's harder to get back to where it was before. So that's why I'm not in a triple leverage one. I'm not saying you won't make money. If this trade really plays out how I think it's going to play out, you'll probably make more money in TMF, but I'm going the safer route and I'm going with TLT. So my expiration date on those call contracts is March of 2025. So in March of 2025, the market's going to be forward looking till roughly October. Now in October, interest rates are expected to be somewhere around 3%. But right now they're at 5%, and the 50 basis point cut that we literally just got, I don't feel like it's priced into TLT yet. The market doesn't really know how to process that one yet, so I feel like if you get in before that gets priced in, meaning TLT will go up after that gets priced in, I think you have an opportunity to buy at a discount right now. And that's also why I'm probably going to add to my TLT position. So like I just said, I did expiration date of March. In March, the market's going to be forward looking until October, and October we're expected to be around 3%. Now the next question you got to know is, how far is the Fed going to cut? What is the neutral rate? Jerome Powell already said the neutral rate is somewhere around 3%. So when March rolls around and the market's forward looking until October, pretty much all of the interest rate cuts are going to be priced into the market already. So at that point, that is when I will sell these call contracts, hopefully at a huge profit, and then I'm done with this trade. So I plan to hold these call contracts till pretty much expiration date, because I think that's how much time it's going to take to really realize money in this trade. So I'm not going to worry about day-to-day movements. That doesn't matter. What matters is a long-term movement that we're trying to capture. We're trying to capture the movement of interest rates from 5.5% to 3%. That is what we're trying to capture with this. So when we have these day-to-day fluctuations of volatility, don't get stressed out about it. Don't worry about it, because if we're in the camp that inflation is going to go down, that means the Fed is going to continue to cut. If that happens, TLT should go up. It's very unlikely that it's not going to go up. So spotting opportunities like this, it takes time to understand the markets and really know what you're doing. So I'm building a course that explains everything that you need to know. It drops in October of 2024. You're going to learn when to enter stocks, when to sell stocks, how to know if they're undervalued or not. My whole stock option trading strategy. Right now I make over $20,000 per month with stock options. Probably in a couple years from now, I'm probably going to be making $30,000 or $40,000 per month, because my strategy will scale with your portfolio. No guarantees, but if you want to learn how I trade stock options, there's a link below for that. It's called the Stocks and Psychology of Money course. Click that link below. You're going to get on a pre-launch pricing list. It's a pretty big discount, so I recommend you do that. And if you made it this far, like and subscribe, and I'll see you guys later.